Is a 620 credit score considered good or is it considered bad? In this video, we're going to discuss if it's good or if it's bad and what a 620 will actually qualify you for. In this episode, we're going to discuss some statistics that are relevant for people who have 620 credit scores. We'll discuss ways to get into the good, excellent category of credit, and then at the very end, we'll have a quick blurb on how to repair your credit. So a 620 credit score actually falls into the fair category of credit. The fair category of credit ranges from 580 to 669, and around 17% of all borrowers have that range of scores. You may or may not know this, but that's actually considered a subprime category of credit. And what does subprime mean? It means that you're probably going to pay higher interest, you're going to pay higher fees, and it's less desirable by creditors. Of the people in this category, 28% of the borrowers in this fair category, 28% of them are likely to become seriously delinquent. And what seriously delinquent means in terms of credit scoring, it means that you're going to go 90 days without making a payment or more. So 90 to 180 to charge off to collection status. 28% of people in this category are going to have that issue. So they're right targets for subprime lenders. So what's confusing about that 620 is that if you hit that mark, you're going to get a flood of pre-approvals, but they're almost always going to be really bad pre-approvals. So now that I've talked about subprime, is 620 considered a bad score? Well, not really. So what can I get with a 620 credit score? Well, as I talked about previously, you are considered in the subprime category. There's going to be plenty of credit card offers that you're going to be able to get. They're not going to be good offers. They're not going to be good terms, but you can get credit cards. One of the biggest questions I get is, can I get a mortgage with a 620 credit score? Well, if you have a 620 mid-mortgage score, and I've created other videos about mortgage score and how that works, then you actually can qualify for a mortgage. I can't tell you how many people come to me as clients and they're like, I really just want to get this house. We pull their credit, we see their benchmark scores are quite high, and then we go pull their actual mortgage scores and they've made the qualification, that 620 mark. Once you've hit that 620, depending on some other factors, usually you're going to have your foot in the door to a pre-qualification on a mortgage. Now, is that mortgage going to be the best offer out there if you pre-qualify for that mortgage at that 620 mark? Probably not. It's probably going to be an FHA loan, which is going to be a federally backed loan. You're probably going to have to pay mortgage insurance, but your rate's probably going to be okay. Is a 620 mortgage going to get you a subprime mortgage? Is it going to get you the best rate? Well, the answer is none of the above. It's probably going to get you what's called an FHA mortgage. It's going to be a federally backed mortgage. You're probably going to have mortgage insurance, but you're going to be okay. You're going to be okay at that 620 mark and still be able to get out of paying rent. Before I get into tips on how to get into the good, excellent category of credit, please like my video and subscribe to my channel. I'll be working hard to bring you a video each weekday concerning personal finance topics, including credit and lending. Okay, so the question is, how do you get out of that subprime area, that fair area, and into the good and excellent category of credit? The number one thing you can do, and I always tell people the same thing over and over again, is to pay your bills on time. You can be proactive, create a budget, put things on auto pay, and pay your bills on time. The very next best thing that you can do is if you have a series of credit cards, is to make sure that you carry low balances on those credit cards. I was just talking to somebody not too long ago in the kitchen, and we were talking about credit utilization and how that may impact a person's credit. A good point was made. If you put everything on your credit card and it revolves maxed out every single month, but you pay it off every single month, remember that you're still revolving at 100%. So before you go to make your big purchase, your big next purchase, make sure that your credit utilization or your credit cards are paid down, and then you have to allow about 30 days for it to update within the credit bureaus. People that have good to excellent credit, they only apply for credit 2 to 3 times a year. So it's reasonable for me to go buy a new car, maybe a mortgage, and to also get a new credit card during the year for a retail store card or maybe a bank card. That's reasonable. So 2 to 3 times every year is reasonable to pull your credit. It's not reasonable to pull your credit 15 times in 1 month looking for credit. That is considered high risk. So what are some ways that I can restore my credit to help expedite the process of getting into the good to excellent category? The first thing you can do is you can subscribe to a credit monitoring service that shows all 3 credit bureaus. Experian, TransUnion, Equifax. Credit Karma is not going to make the cut in this particular situation because Credit Karma doesn't show Experian. We use a service called Smart Credit, and it gives us a beautiful report with all the credit bureaus side by side. It also has different tools that you can use to simulate actions. If I do this, where will my credit score land? It's got identity theft insurance. Click at the link in the description below where it says Smart Credit, and you can sign up for a credit report. Once you've signed up for a sufficient credit monitoring system, and usually those are going to be paid services, you can take a look at each one of your accounts side by side with all the other bureaus. And what we do on our side over here at Creative Credit Solutions is we look for anything that's inaccurate, unverifiable, obsolete, questionable, and we go after the credit bureaus, and in some cases, if there's collections involved, the collection agencies, and then also the original creditors. In fact, we have specialty software that we use that finds these inaccuracies. So what you're going to do is you're going to go through and you're going to try to find any inaccuracy that applies to your specific situation. You're going to look at when the accounts were open, when they were closed. You're going to look at the payment history. If you compare all three bureaus, in most cases, what we find on our side is there are discrepancies. In almost every case, there are discrepancies. You've just got to find them. Once you find those discrepancies, go after the original creditor, go after the collection agency, and then also go after the credit bureaus. Once you find those inaccuracies, you're going to write letters to not only the collection agencies and the original creditors, but also to the credit bureaus, and you're going to talk about those inaccuracies. Hey, on XYZ account, I found this inaccuracy. Please delete the account, right? So you're going to go for broke. Please delete the account, provided it's not an active account and it's got negative history. And more times than not, they'll either correct the inaccuracy, they'll correct, as an example, if it was a late pay to make it not late anymore, or they'll delete the whole account in its entirety. If you're someone who is trying to get yourself out of that fair or subprime category into the good or excellent category, and you're struggling, or you just have credit challenges, please click in the link in the description. We offer a complimentary credit analysis here at Creative Credit Solutions, and the only expectation is that you purchase a tri-merge credit report, and we use a system called Smart Credit.